So oil is hovering near 7-month highs. The Canadian dollar is testing monthly lows, and the DAX is trying to find its footing in a world where tariffs keep changing the script. So before you place your next trade, watch this.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Good morning, I'm Francois, your market analyst here at ATFX Africa, and welcome to your daily market brief. Today we are breaking down currencies, commodities, and indices. 3 intralinked markets reacting to policy shifts, geopolitical supply risk, and global sentiment flows. So let's get straight into it, kicking things off with currency. Now, the Canadian dollar has weakened towards 1.37 per US dollar, touching its lowest level since January 2026. Initially, the loonie caught a brief bid after the US Supreme Court struck down emergency duties, but that optimism evaporated quickly when the US president invoked Section 122 to impose a new 15% global surcharge, reintroducing tariff trade friction. For Canada, an export-heavy economy, trade uncertainty is not just background noise, it's front-page news. At the same time, January CPI cooled to 2.3%, raising expectations that the Bank of Canada could soon abandon its 2.25% pause. That softening inflation backdrop narrows Canada's yield advantage, especially as US core PCE remains at 3%, keeping the greenback resilient. Even with oil firming modestly, the Canadian dollar remains on the defensive. Current snapshot of this currency pair, while USD CAD is sitting at 1.368, down 0.08% on the day. The Canadian dollar touched 1.37, which was a 4-week low. So the dynamic here is clear. Trade friction plus softer inflation plus resilient US dollar equals pressure on the Canadian dollar. That said, let's look at the charts. Technically, 1.37 is the area that is an immediate battleground. Sustained trading above the zone reinforces dollar strength. A rejection with a break back below 1.364 could suggest short-term consolidation. Momentum also remains cautious and policy headlines remain the dominant driver. This isn't a technical-only market. It's a headline-driven one. Moving over to commodities, WTI crude is trading around $66 a barrel, rebounding after 2 sessions of declines. The driver, geopolitical risk. Markets are watching the upcoming 3rd round of nuclear talks between US and Iran. Iran's deputy foreign minister stated they will do whatever it takes to reach a deal, while the US president expressed a preference for diplomacy, but warned of serious consequences if no agreement is reached. All eyes are on the Strait of Hormuz, where roughly 20% of the world's oil passes through. Any escalation there could disrupt supply really quickly. At the same time, the US president's 10% global tariff is now in effect, with efforts underway to raise it to 15%. Traders are weighing potential demand impact from these new trade measures. So oil is balancing supply risk premium, which is bullish, trade-related demand uncertainty, which is cautious, which is creating the following quick snapshot. Crude is currently at $65.90 per barrel, up about 0.5% on the day, and up 8.8% over the past month. When we do look at the charts, the pivotal region around $66.20 has acted as near-term resistance. Holding above this level could keep short-term bullish momentum intact. The upper barrier closer to that $70 a barrel zone is also definitely worth watching as an upside target. Downside support is currently sitting near $63 if sentiment shifts. This is not a runaway momentum commodity at this point in stage. It's structured resilience. Oil is firm, but not complacent. Finishing things off for today with equities. The DAX is walking a tightrope between trade caution and corporate resilience. Frankfurt DAX closed virtually unchanged around 25,000 yesterday. Markets continued to assess shifting trade narratives after recent US tariffs, while investors looked ahead to the US President's Union speech. Autos found some relief after US tariffs on Europe were set at 10% for now, below the threatened 15%. But weakness remains visible. Medical care plunged 7%, MTU Aero engines slipped 6.4%, SAP and Deutsche Bank also declined. So while the index isn't collapsing, volatility is clearly present. Now, over the past month, the DAX is up around 0.6%, and over the last 12 months, it's up around 10%. So looking at the charts, the DAX recently bounced near the 24,900 pivotal area, suggesting buyers are still defending key zones. Near-term resistance is sitting at 25,500. Support is currently at 24,280. So traders, in simple terms, the DAX is cooling, but cooling from altitude. A break above resistance would signal renewed appetite, while a slide below support would confirm risk of flows gaining traction. So what should you be watching for today? Well, three major drivers could shape today's session. USMCA and trade policy headlines. Any clarity or escalation here could directly impact currencies and broader risk sentiment. US nuclear talks and Strait of Hormuz developments could, affect oil, which remains sensitive to supply risk narratives, and global equities tone. So if European indices stabilize, it could calm risk flows. If they weaken further, defensive positioning may accelerate. Markets today are interconnected. Oil impacts Canadian dollar. Trade impacts equities. Equities influence broader risk appetite. So it's less about one asset and more about the flow between. And with that, we wrap up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to atfx.com and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.